Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. Today, we are undertaking a deep dive into the absolute turbulence of Friday, November 14th, 2025.
Yeah, turbulence is a good word for it.
We've synthesized a massive stack of sources. We're talking CNBC, Yahoo Finance, Bloomberg, and Reuters. And the picture they're painting is, well, it's not just uncertain, it's contradictory.
Exactly.
So our mission today is to cut through that noise and figure out why the financial world seems to be splitting in two. You've got this high-flying speculative mania and then this painful economic reality on the ground.
What stands out immediately is how these two forces are just clashing. Markets are grappling with the potential unwinding of the AI revolution, and that's driving massive volatility at the top. But at the very same time, political action is being forced by a worsening affordability crisis that's gripping the average consumer.
So it's a perceived technological future clashing head-on with a very, very painful economic present.
That's it.
Okay, let's unpack the carnage first. The tech sell-off was brutal on Thursday, and it just kept going into Friday.
It really was.
We saw the NASDAQ composite tumble 2.29%, which marks its worst day since, mid-October?
That's right. And it hit the heavyweights hard. NVIDIA, Broadcom.
Even Oracle slumped significantly.
And that volatility was global. We were seeing reports from, I think it was CNBC's Asia desk, that confirmed the pain spread really quickly.
So the Nikkei, South Korea's Kospi.
Both fell sharply.
Yeah.
This confirms that it was risk aversion, not just simple profit-taking. That was the central theme.
And here's where the market action gets really interesting. SoftBank, that huge Japanese conglomerate, disclosed it sold its entire stake in NVIDIA.
The entire stake.
The whole thing for $5.83 billion. That is a massive liquidation.
Wow. So does a move like that from a key tech investor suggest they're hedging against this bubble theory? Or are they just locking in huge profits before what they see as the next wave?
Well, it seems to directly contradict the optimism we're hearing from some corners.
It creates a fascinating juxtaposition. On one side, you have the optimistic camp. I'm thinking of Mary Callahan Erdos from JP Morgan.
Right, at the CNBC Delivering Alpha conference.
Exactly. She completely dismissed any bubble concerns. She called AI a major, major revolution. And even used that famous Hemingway line.
About bankruptcies.
Yeah, how they happened very, very slowly, and then all of a sudden. Her point was that we're nowhere near the all of a sudden part because the full opportunity hasn't even been realized yet.
But the pessimists are they're sounding alarms that feel very reminiscent of the dot-com bust.
Oh, absolutely.
We saw Jim Cramer issue a powerful warning on CNBC, and he highlighted the danger in speculative stocks, the insider selling. He said it smells suspiciously like the lead up to the 2000 crash.
He thinks the AI mania is starting to unwind.
Right, and it's not just the finance guys, is it?
No, and this is the interesting part. This caution is coming from CEOs inside the AI industry itself. The leaders of DeepL and Pixar told CNBC that they believe sector valuations are, and I'm quoting here, pretty exaggerated.
Pretty exaggerated.
Yeah, they noted that many startups are raising just incredible amounts of capital based on just some noise and vibe revenue, not concrete profits.
So that really underscores a key uncertainty for you as an investor, right? Is this a genuine infrastructure boom, or is it just a speculative frenzy driven by fear of missing out?
Precisely.
So we have a stock market grappling with a potential bubble. Now let's pivot to the central bankers who are, flying blind.
Completely blind.
The government shutdown ended, but the data vacuum is real. Bloomberg and CNBC both noted that without reliable official data like the Consumer Price Index, the CPI,
or non-farm payrolls,
the Federal Reserve simply cannot accurately assess the current state of the economy.
And this is where the synthesis really matters. The problem for the Fed is that the data they are missing, granular figures on consumer spending, lower-end employment, that's precisely the data that validates the need for political intervention in this K-shaped economy.
Okay, I see.
Meanwhile, the data they can sort of infer high-end investment, those AI valuations, that supports holding rates. So this duality, it prevents any kind of clear monetary policy path.
And that visibility gap has just completely reset expectations for rate cuts.
Totally.
According to the CME FedWatch tool, the odds of a December cut have plummeted. We went from a near certainty, 95.5% a month ago?
Something like that, yeah.
Down to roughly a 50-50 coin toss today.
And Fed officials are just reinforcing that uncertainty. You had Boston Fed President Susan Collins suggesting they hold rates at the current level for some time.
And Neil Kashkari from the Minneapolis Fed told Bloomberg he's still entirely undecided for December.
He basically said, I can make a case, depending on how the data goes to cut, I can make a case to hold. Total ambiguity.
So predictably, this uncertainty has pushed capital towards safety and away from risk.
Of course.
In the crypto market, that risk aversion caused Bitcoin to fall further below that $100,000 mark. And crucially, Bloomberg reported that Bitcoin ETFs saw massive net outflows.
How much are we talking?
About $870 million on Thursday alone. So that confirms a genuine risk-off shift.
And conversely, the traditional safe havens are thriving. Gold prices were up, heading for their best week in a month, really just buoyed by the general instability.
Right.
And internationally, the Swiss franc surged to a 10-year high against the euro. That's a classic flight to safety move, plus some expectations of stickier Swiss inflation.
We also saw some sharp volatility in the UK bond market. Reports from CNBC indicated that speculation about an income tax U-turn in their upcoming autumn budget caused UK government bond or gilt yields to spike. That directly raises borrowing costs, and it caused the FTSE 100 to shed over 1%.
The message is clear. When the Fed is unsure, markets become allergic to risk, whether it's domestic or international.
So we have chaos in the stock market and paralysis at the Fed. But what does this financial volatility actually feel like on the ground for everyday families?
Yeah, that's the real question.
Let's pivot to what our sources are calling the K-shaped economy, because that seems to be where the real pain is forcing political action.
That K-shape is such a critical concept. It's that divergence between those benefiting from asset inflation and those who are just being crushed by consumer inflation.
And Mohamed El-Erian of Al-Arians, he was cited in Yahoo Finance.
Right. He's warning that recession-like conditions are already gripping households on the lower end of that income spectrum.
Already there.
He argues this cohort is, in his words, close to 1, because the persistent 3% inflation, that affordability crunch, it just lacks the economic cushions we had before.
Like the government subsidies or those big wage bumps.
Exactly. Those things that offset past difficulties, they're not there in the same way.
And he emphasizes the contamination risk. El-Erian stressed that if these lower-income households stop spending, and this is key, not because they don't want to, but because they're unable to, that financial pressure will contaminate upwards for the economy as a whole.
And that's the key difference between just a mild slowdown and a serious consumer-driven recession.
And that pain is what's driving this policy pivot. After those recent election losses, the Trump administration is focusing squarely on combating what they're calling the affordability crisis.
CNN dubbed it a Plan B strategy.
Right. And part of that plan involves floating the idea of $2,000 tariff rebate checks, a tariff dividend.
Funded directly by tariff revenue. Right.
Exactly. But critics immediately flagged that if you inject that level of demand without increasing supply,
you're likely to make inflation worse.
Precisely. You undercut the very affordability goal you're trying to achieve.
They're also looking at some radical mortgage solutions to fix the housing crunch.
Yeah, this part's fascinating. I saw mentions of portable mortgages and these extremely long 50-year mortgages.
But portable mortgage idea is interesting because it would let you carry your existing low locked-in interest rate from your old house to a new one.
Which would unfreeze the housing market.
It could, yeah. It would mitigate the current rate shock with those 50-year mortgages.
Highly controversial.
Yeah, very. Critics argue it's not a solution, it's just masking the problem. You're essentially turning a 30-year purchase into a near-lifetime rental agreement with the bank.
And you end up paying vastly more in total interest. Many people would never really build equity.
Right. And to directly address consumer prices, Treasury Secretary Scott Bessent announced targeted tariff cuts on some non-U.S. grown produce, like coffee and bananas.
Which highlights this double-edged sword of protectionism we've been seeing.
It does.
Okay, but help me understand this. If the U.S. puts tariffs on foreign beef, why did the price of American beef soar 18% in September?
That's a great question, and it gets to the core of the complexity. Because demand is constant, but you've fractured the global supply chain.
Okay.
CNBC reported that when tariffs were imposed on major beef suppliers like Brazil and Australia, the cost of their imports went up.
Sure.
So that meant everyone had to compete harder for the limited domestic U.S. supply, which is already low because of U.S. cattle herd issues. And that pushes the price of all beef higher for the consumer.
So the tariff effectively acts as a consumption tax on everyone, foreign and domestic.
Exactly. And that's why these targeted cuts are now being seen as necessary to ease those specific, very visible pain points for consumers.
That complexity really shows the difficulty in balancing global trade with domestic pricing. Okay, before we wrap up, let's look quickly at global business. Specifically where AI is actually proving its value versus where corporate governance is showing stress.
On the value side, while a lot of AI firms are worrying about profitability, some established financial institutions are reporting solid gains. DBS, Southeast Asia's largest bank. They expect AI adoption to result in over $1 billion Singapore dollars. That's about $768 million in additional revenue this year. It's not hope, it's now. It's already happening.
And we see that applied specifically in finance disruption, too. China's Alibaba.com is rolling out a new AI mode subscription service.
Right.
But more crucially, their cross-border ARM plans to use tokenization technology, and they're potentially working with JP Morgan to speed up global B2B payments.
So for you, the listener, what tokenization means here is they're turning payment obligations into digital tokens on a blockchain.
And those can move instantly and cheaply.
Exactly. Potentially skipping several of the intermediaries you need in traditional cross-border commerce.
Okay, so now let's pivot to corporate stability, where risk seems to be rising.
Yeah, definitely. The weight loss drug giant Novo Nordisk is facing a major leadership shakeup.
A CEO change and a board replacement.
All of it. It's happening amid plunging shares and waning investor confidence.
And this is because investors, including minority shareholders like NBM and CalSTRS, are expressing serious discontent as the company's market position is being challenged so intensely by its rival, Eli Lilly.
Right. We're also seeing risk management tightening in the auto sector. China's BYD is reportedly moving away from its controversial in-house financial notes system.
The Dillion IOUs.
Those. Reuters explained that these IOUs were essentially promises to pay suppliers later, but unlike traditional bank-backed notes, they were perceived to carry a much higher default risk.
And that strained BYD's relationship with its supply chain, especially during this brutal price war.
So a shift away is costly for them, but it reduces that systemic risk.
And finally, we should probably briefly acknowledge two high-profile, non-market stories that were all over the headlines. Goldman Sachs publicly reaffirmed its support for its top lawyer, Kathy Rumler, after her private emails with Jeffrey Epstein were released.
Right. Correspondence had happened before she joined the bank. Goldman emphasized it was private and professional.
And separately, President Trump threatened a $1 billion lawsuit against the BBC over an edited documentary clip related to his January 6th speech.
And the BBC has since apologized for what they called an error of judgment in the edit and agreed not to show the documentary again on its platforms.
So this entire deep dive really underlines the extreme contrasts defining the current financial landscape. You have the technological euphoria of AI driving massive volatile gyrations at the top of the market,
Juxtaposed with the persistent structural pressure of the K-shaped economy, forcing these radical political shifts at the bottom.
The focus has undeniably shifted to policies designed to, as the administration branded it, make America affordable again.
It has. But considering the complex mechanisms we just discussed, how tariffs that are intended to protect jobs can ironically drive up consumer prices on staples like beef, and the introduction of these controversial new instruments like 50-year mortgages, the question for you, the listener, remains. How quickly can government action truly solve a K-shaped crisis that has been brewing for years? Or is the speed and urgency of these new policies simply creating new unforeseen risks down the road?
A compelling question to mull over this weekend. We appreciate you joining us for this analysis of the headlines. Be sure to check your sources, do your own research, and we'll see you all Monday morning with new headlines from major financial magazines.